Good evening, ladies and gentlemen. I extend a very warm welcome to all of you for this discussion on the present-day budget, sponsored by the US-India Importers Council and Artham Law Chambers. USIIC is a very important organization today. This was formed during 2011 during the visit of President Obama to India with the objective of bringing together small and medium enterprises in India with small and medium enterprises in the United States. In that process, it also provides facilitative service to other large firms. It's headquartered in Mumbai and has branches in almost all major cities, including United States in Baltimore, Maryland. Today, this webinar themed ARTHAshashtraM 2022 has a galaxy of speakers who are going to give us their excellent analysis on the budget. Friends, as all of you know, this year the finance minister's speech was the shortest, sharp, and to the point. It came out of 2 years of pandemic and the agenda was very clear. The theme was focused on large-scale capital investment for macro growth and big push towards digital economy and technology-enabled growth and development. With this background, I would like to introduce to you Punit Shah of Dhruva Advisors, one of the leading financial advisors having their offices in Mumbai, Dubai, Singapore, United States. He has over 30 years of experience. Punit Shah specializes in banking, financial services, private equity sector, and in tax policy issues. Prior to joining Dhruva Advisors, Punit was the co-head of KPMG's tax practice for Western India. Over to Punit, sir.
Thank you. Thank you for that kind introduction. On my part, I would like to deal with direct tax proposals. Essentially, the budget, we were expecting some big bang reforms and some significant amendments. However, the budget has not, the finance bill has not come up with some very path-breaking changes, but there are several changes which are significant in nature and which does affect a wide variety of taxpayers. I would like to deal with a few of them. I would like to highlight what are the changes. I would like to highlight what is the impact of those changes on certain taxpayers. The first one being the tax rates. There was a widespread belief that the finance bill or the finance minister would tweak the tax rates, at least for individuals, because today we have very high rate of taxes for individuals. It can go as high as 43%, including surcharge, while for the tax rates for companies and LLP are restricted to as low as 15%, in some cases 25% and maximum 30%. So there was a need for the tax rates to be reduced for individuals. However, those tax rates are completely unchanged, untouched, and those remains the same. However, one very interesting change which the finance minister made is the surcharge on long-term capital asset has been now capped at 15% instead of 25%, and it can be as high as 37%. So tax rate would come down drastically on the long-term capital gains earned by the individuals on any long-term capital asset. That would include listed shares, unlisted shares, any capital asset, land, building. So that's a significant saving of 4% tax rate on account of reduction of surcharge or capping surcharge at 15%. So a very welcome change to my mind. The second change in rate of tax, again, it was quite expected that there will not be any change of rate of tax for companies or LLPs or firms, because they are already quite competitive as compared, even if you look at the globally competitive tax rates. However, one small change has been made. Again, very good, very nice change is that in case of consortium of the companies which are doing activities in India, where all the members are companies, the surcharge again will be capped at 15%. So again, it's a welcome change. It would help. Again, that's the step is in the direction of giving fillip to infrastructure sector, where this consortium play a very vital role. So a very welcome change in these two changes in tax rates. Coming to the next set of amendment, very, very interesting change where this was absolutely expected in the budget, which is taxing virtual digital asset. It's like cryptocurrency or any other asset, NFTs, any asset which you call virtual or which you call digital is now liable to tax at the rate of 30%. There was a talk that either it would be regulated, whether it is legitimized, not legitimized. A lot of discussion around that. There is no clarity as of today, and there has been a lot of discussion post-budget whether taxing cryptocurrency or taxing virtual digital asset is actually legitimizing the asset at all. But today we don't have an answer to that. The government or Reserve Bank will be able to provide that answer. But the tax office or the tax revenue authorities are saying that if you are making money on trading on say cryptocurrency or crypto assets, I need my share of taxes, and the rate of tax should be 30%. Even and the surcharge for individuals will be as high as 37%. So that has now been introduced. It has been treated very, very strictly in the sense that if there are losses which an assessee incurs in trading a virtual digital asset or a cryptocurrency, those losses will not be allowed to be set off against any other income, any other mode of income earned by that individual. It will not be allowed to be carried forward to the next year to be set off against any other income. So again, it's a very, very stringent provision comparable to a speculation income or a speculation business. Another provision with relating to virtual digital asset is TDS at the rate of 1%. So government wants to track the transactions which are entered into on cryptocurrency by Indian individuals. So there is a TDS of 1% on payment to resident by anybody who is making this payment. So again, the transactions will be tracked, and that is the intention of the government of India. There is one more interesting change which has happened, which is dividend and bonus stripping. Very, very interesting. Today, if I may explain very briefly, in case an assessee or a taxpayer invests into shares or mutual fund units and earns exempt dividend, and then sells the shares or mutual fund units and incurs losses, in that case, the losses are disallowed to the extent of exempt income because you have entered into that transaction just to earn the exempt income and incur losses. And losses can be set off against other taxable income. So in order to avoid this kind of practice, the dividend stripping is not allowed. Similarly, bonus stripping is not allowed, where you incur when you invest in shares, earn bonus shares, and then sell those shares, original shares at losses, and claim those losses against other taxable income. Today, bonus stripping applies only to the mutual fund units. It does not apply to shares and securities. Now the law is amended to include the shares and securities as well in the bonus stripping provisions. They have also included the units of AIF, alternative investment funds. They also included units of REITs. They also included units of InvITs in these provisions. I think it was it's something which was expected because of some of the practices of bonus and dividend stripping in the market, and those losses will be accordingly disallowed if the purchase sale transactions take place within a specified time period. The next set of amendment is relating to filing tax return. A very interesting amendment has been made. Today we have a provisions for filing tax returns, normal tax returns. Then you file belated tax return. You can file revised tax return. You can correct defects in the tax return which you have filed. So there are various provisions which are available. Now they have introduced another concept of updated tax returns. A very interesting provision where in case the taxpayer has erroneously forgotten some income to be included in the return of income, the taxpayer can file updated tax return for next 2 years from the end of the assessment year, correcting that error, offering that income, additional income for taxes, pay normal taxes on that additional income, pay interest on that tax, and plus pay 25% additional tax as penalty in case the return is filed within 1 year of the end of the assessment year, or 2 years, or 50% as additional tax if the return is filed after 1 year but before 2 years. It's like an amnesty scheme. It's like a ongoing amnesty scheme provided to taxpayers, that as and when you think that you have forgotten or you chose not to report a particular income, then, and you have an afterthought, you have a change of mind in the next 2-3 years, then you can actually file updated tax return, offer that income to tax and pay additional tax, and that's about it. Of course, this updated tax return cannot be filed if the assessment notice has been issued already, and therefore maybe this 2-year period may be truncated if the notice period is already issued for that particular assessment year. The next set of changes, the foreign dividends, in case the Indian companies are holding subsidiaries or more than 26% stake in a foreign company, and that company declares dividend, it was taxed at 15% today. That provision has been removed, and therefore the Indian company which is receiving foreign dividend will pay tax at a higher rate, as a normal rate, and that 15% concessional tax rate has been removed. Similarly, 2 important amendments. The Indian domestic company which is into manufacturing, new company which starts manufacturing, is liable to tax only at the rate of 15%. That provision was ending on 31st March 2023. They have extended this period to 31st March 2024. A very welcome step. And also for startups, to give incentive to startups, startups profits are non-taxable or exempt for a period of 3 years, consecutive 3 years, in a period of 10 years after commencement of the business. And that incentive was also getting over by 31st March 2023, which is also now extended by 1 more year to 31st March 2024. So these are some of the important provisions which I thought I should discuss. Thank you very much.
Thank you very much, Punit. That was a very lucid presentation on your part. I'm now moving to Mr. Raghavan Srinivasan, a senior business journalist, very well-known columnist, and he has been reporting, analyzing, and interpreting the Indian growth story since the inception of the economic reforms in India. He is passionate about social changes and was instrumental in breaking major stories like the Harshad Mehta scam, the return of the Coke to India. He has been on the board of many leading newspapers and journals, and he is the recipient of the well-known M.V. Kamath Memorial Award for Lifetime Excellence in Journalism. With these few words, sir, may I request Srinivasan, sir, to make his analysis. Thank you, sir.
Thank you, Mr. Srinivasan. I almost feel like I'm back in the Hingoo. One day, on an ideal afternoon, I sat and counted the number of Srinivasans who were present in the Hingoo system. And I gave up at around 76. It was too tedious to go through all the names. So anyhow, I would like to thank the USIIC for inviting me and giving me this opportunity. I think that it's a commendable effort that you're doing, particularly for MSMEs. I think, MSMEs, everybody talks about MSMEs, but very few people actually do something which concretely helps them. So kudos to all of you. So coming to budget 2022-23, by now all of you are familiar with the numbers. The big headline number, of course, was the big step up in capital expenditure, and the fact that fiscal deficit for last year actually overshot even the revised estimate, and is targeted to be reduced by only about 50 basis points in the coming financial year. So from an actual of about 6.9% of GDP, it is targeted to reduce to 6.4% of GDP. I will come to the implications of this in a moment. But, first, if you're looking at what are the broad sweep impact of this budget proposal overall, The initial take, of course, is that it is pro-growth, particularly because there is an attempt to improve the quality of, it's not just government spending more money, but there's been a clear attempt to improve the quality of spending, which is that you spend more on trying to create assets, productive assets, which in turn fuel growth rather than on non-productive consumption expenditure, right? So that's a broad takeaway from the top.
Yeah.
The second, of course, is that on the fiscal deficit front, the pandemic is still not behind us. There was widespread consensus over the last 2 years that during a time of extreme crisis, once in a lifetime kind of pandemic that hit us, the government's primary responsibility was to step in and see that the wheels of the economy kept turning. And if that meant, pushing the deficit numbers out of the window for a little while, so be it. So that has also been done, going by the numbers. So, but as is with everything with the this dispensation, they're very good at headline management, and basically the headlines are always very positive, very gung ho. But then once the details start emerging, once you dive into the fine print, there are other question marks which come up, by which time the debate has shifted to some other topic. So, they're always ahead of the headline curve, if I may say so. But take the capital expenditure increase, So the nominal number is that it has been increased by about 2 lakh crores, and adding the, central support to states for capital expenditure, the effective capital expenditure is in excess of 10 trillion rupees. And that's a huge number, 10 lakh crores plus, 10.64 lakh crores. That's a very large number, but the reality is quite different in the sense of, if you and I understand capital expenditure as expenditure to actually create physical infrastructure, right? So, if there's money, if 10 lakh crores are being spent to create buildings, roads, bridges, airports, ports, railways, networks, and trains, then it is fantastic. And that will provide a massive booster dose to the economy. And there would be downstream impact for virtually all non-finance sector companies. Every aspect, it's not just steel and cement, but literally every company which is not only purely dealing with financial products is likely to benefit. But if you go into the details a little bit, there are a lot of things the government has done in the way it has sort of added up the numbers, which are a little distinct. So, a lot of expenses which one wouldn't consider capital expense have been absorbed as capital expenditure.
Yeah.
For instance, 73,000 crore provision for NREGA, the Mahatma Gandhi National Rural Employment Guarantee Scheme. It's basically a sort of, it's a social support scheme. So where, which guarantees a certain minimum number of days of employment, 180 days in a year, to any willing member who seeks work. And that work is given at the minimum wage. So it's essentially income transfer by indirect means. Now, they have taken it as capital expenditure because NREGA, in theory, the NREGA funds are supposed to be used in public works. So, the NREGA funds are allotted, and then after that, it is supposed to be spent on projects which are to create assets. The reality is that a lot of the NREGA projects exist only on paper. At best, there have been any number of reported cases of, where you're just doing something, you're digging holes and filling them up again. Almost, So how much of this 73,000 crores will actually relate, translate into actual infrastructure, like a road, like a school building in a village, like a well or a refurbished lake or a pond? It's a question mark. So, but 73,000 crores here. the government spent 50,691 crores, if I remember the number right, on settling the dues of Air India before handing it over to the Tatas. This entire amount has been taken as capital expenditure. Okay. So, the debts of Air India are gone. I mean, those dues have been settled because the balance sheet had to be cleaned up before the Tatas took over. But to say that this was capital expenditure and we have created productive, where is the asset? So that is not this thing. Then you have 1 lakh crores, which is actually by way of loans to states through 50-year bonds. 50-year long bonds that the government is going to borrow and give that money to the states in order to spend on capital infrastructure. But it's a loan, right? An expenditure. I mean, I'm not an accountant, and I'm sure Mr. Shah would, probably correct me here. But, as the common man understands it, if you spend money for something, it is an expenditure. And a loan is different. Loan has to be repaid. But 1 lakh crore rupees of that is actually a loan amount. That's also been added as capital expenditure. How the states, when the states will get it, how they will use it, what is their capacity to actually utilize it productively in building capital assets, these are all question marks. But if you take all that away, then the actual increase in capital expenditure, there are many estimates, but it could be as low as 65,000 crores. Where is 65,000 crores and where is 6 lakh crores? So that's a big thing. So that's, what is the downstream impact on this thing? The Sensex went up 1,500 points when the FM was reading out these numbers, and I think corrections are happening now in the marketplace. That's because, people realize that, first of all, the amount is not going to be so much. It's not, 34% of GDP. And it is not going to be all spent in 1 year. And a lot of it is not even capital expenditure as you and I understand it. So then the downstream impact on growth is going to be somewhat muted. The second big aspect, macroeconomic aspect of this budget is that it's an expansionary budget. So, there is a big spending program, and the government's market borrowings are slated to go up sharply. As I mentioned earlier, the fiscal deficit numbers have also been kept very conservative in the sense that there is not a big step down in fiscal deficit which is projected to take place. So this means that there is there are 2 or 3 things. One is that I think, the cost of borrowing is going to go up for everybody, right? So there's a large amount of government borrowing. So there are 2 aspects out here. One is the crowding out of private borrowing, and the second is a rise in the cost of borrowing because, bond yields, which is how the market sort of decodes the actual cost of government borrowing, they've already shot up. Averaging around 6.8% for 10-year bonds. So if the government's borrowing is at 6.8%, then everybody else pays that much more extra, right? The government is sovereign, that's the lowest thing. So there is going to be an increased cost of borrowing for everybody down the line. Okay. There is also obviously going to be a large increase in money supply, which means that inflation will be a problem. And inflation, we have, and the economic survey talked about a little bit about imported inflation, but it's a real problem, right? The US currently is experiencing the highest inflation rate in 40 years. It's around 6.8%. These levels of inflation are unknown in the US. At home too, inflation rates have been creeping up. WPI is very high. It is in the double digits. CPI is still within the RBI's comfort band of, under 6%. But wholesale price index, which is now less considered, but which is directly relatable to businesses, because WPI is far more relevant to a business, right? Because that's the cost, that's the inflation in your costs of inputs and raw material. And that's already running in the mid double digits. So inflation is a real threat. We have other external imponderables, so one of the assumptions, for instance, in calculating the fiscal deficit and other things is that, how much are we going to spend on imports for the year? We import most of our energy requirements. So one of the key assumptions is that oil prices will rule around $70 a barrel, right? So as we speak, the United States has sent warships off the coast of the UAE. Fighter jets have gone. The situation there is flaring up. The conflict between Yemen and Saudi Arabia and UAE because of the Houthi situation. Immediate impact on oil energy prices. Natural gas, which is the other big energy source, we have the very real possibility of armed conflict between Russia and NATO forces building up on the Ukrainian border. Russia is the largest supplier of natural gas to Western Europe. Already gas prices are shooting up in the traded markets because of the fear of potential disruption of natural gas supplies from Russia to Europe. So these are all imponderables which have not been, I believe, adequately factored in. And so, the outcome, if we look at it 1 year down the line, might be very different from the picture which was apparently painted at the start of the year.
Exactly.
So that is something to be kept in mind. And but otherwise, like I said, the budget has, remarkably otherwise has been fairly conservative exercise, in the sense that I must say that, even though all these, off budget and other expenses have been consolidated into capital expenditure because they wanted to show something, but otherwise government accounting has got a lot more transparent. So in that sense, this budget is a very more straightforward exercise. I would say that in some ways it has under-promised and they will over-deliver. So tax collections are going to be much higher than what they have projected. The fiscal deficit, I think, will be lower, and there are some, big elements coming up, the LIC IPO and so on. So broadly on the macroeconomic front, I think that there is a lot of positives for the real economy, right? But there is also potential threat of inflation and cost of, and I think increased cost of borrowings is inevitable at all levels, starting with the government and down to individuals. These are, broadly the takeaways that emerged after when I looked at a little bit at this. The disappointing part of the budget for me has been the sort of, basically the social sector has been ignored, particularly education. Education outlay, there was a nominal increase in educational outlay of about 9,000 crores. But again, you have to look at last year, it was actually cut by 5,000 crores. So if you compare to 2018-19, then we are up by about 2,500 to 3,000 crores. So not a very, this thing. And we have had school closures for 2 years. It's the longest school closure in the world. No other country has closed schools for such a long period. And the impact on education and learning outcomes is very, very real. And the problems which came up because of that, those have not been, addressed. Healthcare, for instance, expenditure has also been capped at more or less the actual level last year, which means there is an assumption that the pandemic is over and there will not be any need for any emergency spending on healthcare as well as on vaccinations. And these are two big ifs, because we have just started the booster dose regime, and that too only for people, frontline workers and those with 60 plus with comorbidities. Most other countries have completed booster dose even for their young people, right? And I think it is very clear that sustained and continued vaccination is going to be the only key to keeping the wheels of the economy moving, keeping activity happening, the physical movement taking place in an economy. So to that extent, I don't know whether this assumption is a valid one, and I would have liked to see some more this thing. But I will stop here and maybe address any other questions which people may have. But since the topic was broad macroeconomic takeaways, these are my 3 or 4 points.
Thank you very much, Mr. Srinivasan. We will now move to Mr. Rajiv Hingoo, the Managing Director and COO of Jefferies India. Rajiv is an accomplished C-level executive with international perspective, proficiency in operating models, and country-specific segmentation. Besides India and Hong Kong, he has served in several countries on brief stints: Singapore, UK, Middle East, Japan, China, and USA through his 25 plus years of career. He is a multinational executive, and looking at the way he has served abroad, he is more like a foreign service officer. He is piloting Jefferies India, which is an American multinational independent investment bank, and Jefferies are one of the leaders in capital market and financial advisory services. Sir, with these few words, may I request you to give your analysis and your opinion on the budget. Over to you.
Thank you very much. A very good evening to everyone who's logged in and even on the panel. It's a pleasure to be here and share some of my views. I think Mr. Srinivasan basically stole the thunder, where he's evaluated the budget, in a very threadbare fashion. I think it's so. Yeah, I think from my standpoint, I'll talk about it at a slightly higher level, similar to what Mr. Srinivasan did, and there are maybe some points which I fully agree with his analysis. And maybe there are some points where I feel that there is room for some more optimism and, hoping for the government to deliver on what it's kind of promising, or at least showing as a trajectory in their communication, right? So, again, two things, and at the cost of being a bit repetitive, I think fiscal consolidation and capex-driven growth. I think over here, I firmly believe that it's a consistent theme, right? And I think consistency is what matters, because this is a second year in running that they have kind of stuck to this theme of going for some organic and capex-driven growth. And historically, we've seen that, in India's growth story, there's always been a parallel comparison to China, right? And China, in my view, being the biggest socialist or communist country in the world, in my view, actually they are the biggest capitalists, right? And the way they go about building their businesses and infrastructure is something which the world has learned from, and we are still learning from. So I think in India, it is important that we give impetus to this whole capex and growth story, capex-driven growth story, because that has what has contributed to China's growth in the past few decades, right? Where a substantial amount of their GDP and financial growth was denominated by the amount they spent on their infrastructure. Yeah. Moving on, I think, yes, I fully agree with, again, with Mr. Srinivasan that there's a very flat non-capex budget, which means that there is very little additional for the consumption growth story that we've been, experiencing in recent times. And that's primarily driven by the pandemic. But what does it mean? It means that we are going back to basics to generate momentum by creation rather than printing and handing down money to spend, right? So in my view, I feel that it's a more consolidated approach towards bringing long-term momentum and growth in the economy, right? And again, a simple question: why are we going in this direction? I think this is again a global phenomenon, which he previously mentioned. With respect to the whole increasing interest rate regime, which we are going to, or rather we have, or we will see in the coming few, quarters. And that's something which is obviously going to convert into inflation, right? Going on that path further down, right? I feel some analysts whom I interacted with have coined a term called genius effect, right? So let's first state the obvious to frame the conversation that when rates are low, everyone is pushed into riskier assets. And again, I'm not an economist, so I'll talk from a standpoint of capital markets and what it means from various asset classes that investors look at to invest into, right? So when rates are low, everyone is pushed into riskier assets because the world is starved for yield and opportunity, right? So you have pension funds, retirement accounts, endowments, all needing to generate returns for their constituents, right, and to pay their obligations and expenses. So there is very limited yield available because the treasuries are, going at a low rate. And that's when everyone becomes a risk taker, right? So an ever increasing flow of money enters even riskier assets. Their prices grow up. Investing seems easier, more fun. And then everyone is very smart, right? Everyone is a rock star investor in the scheme of things, which I think we are experiencing in India as well. Right. The next one, which again I was very, and this is not me, right? This is some of my analysts saying it, that trees don't grow to the sky, right? So trees grow, but they don't go all the way to the sky, right? And value investing has always been very disappointing for a very long time. So continued low interest rates have contributed to what many believe is the end of bottom-up financial analysis, where things like stability of earnings, cash flow, tangible book value, capital structure, margins, and all those things really mattered, right? But recently, if you see the trend, we're looking at growth and innovation is all that mattered. Multiples of revenue, top line, right? Sorry. Yeah. So yeah, that's what mattered the most, in recent times, where we rely on growth and momentum and derive valuation merely by looking at valuations of, similar high valued businesses, right? So if you look at, say, the new fintech companies and the new, app based companies, the bottom lines are negative. They're burning cash, but the valuations are based on their growth, and which is what the new age, investing is all about. So there will be a day of reckoning, right? When interest rates will go up, the cost of risk will go up with it as well, right? And in fact, there'll be multiple points of reckoning, as valuations can just be a number of, is it a number which collapses under such pressures. Last thing I'll say is, that's something which is, I have seen this. We saw it in, the early 2000, the tech burst. We saw it in 2008-9 when, the financial crisis went through. And then now during the pandemic, right? Transitions hurt the most. So just like human beings, economics and markets are also most disoriented during periods of uncertainty, right? It's if rates are stable and low, or even stable and high, we all adjust to the rules of the game and decide our strategy and execute, right? It is only in these periods where we are right now, in my belief, which is the in-between period, right? It's very difficult to understand what the current reality is, to figure out what next. And that's when the wheels normally fall off the cart. So I firmly believe that the job of central bankers is far more complicated and delicate as compared to what we make of it, right? And at this point, I would really like to commend RBI for the way, and history has been, right? Whoever's run RBI for the last 20 years, I think even during financial crisis, during the tech burst, and now in the pandemic, I think RBI has done a great job, right? So there has definitely been a great impact in their policies over a period of time, and this has clearly helped the Indian economy, stage a comeback even from the worst of times. So if you look at that, then I think these are the most volatile and dangerous periods of market cycles. So while they are so uncomfortable and it feels like these periods will never end, I think they end quickly, right? We've been through them. And usually the recovery is a hockey stick, which is what we experienced in 2000 as well. But now having come to a stage where we are going to be in an artificial area, right, of interest rates being, being let loose, and there is a crunch on liquidity, right? I think things will adjust very quickly again, right? So I, at the end of all this, would like to believe that maybe some part of this insight has gone into the budget genesis, right? Because that's what we are as a nation or an economy in the midst of the entire global scenario trying to, put up. There are a lot of other points, right, where I think the budget has shown, some path. One is obviously the entire digital piece. That I think has been a great move ahead, right? The next one is you look at, how they are enabling the startup ecosystem as well, right? I think that is a good positive overall. And, I think over a period of time, it is something which will play up in the overall scheme of things where life will become that much easier, right? They say Rome was not made in a day. So I'm sure, if implemented correctly, and that's the word I use very often, right? And I agree with Mr. Srinivasan when he says that conceptualizing, throwing, jargon, throwing, fancy consulting words and themes at the population is one thing, but implementing is something completely different, right? And that I would like to give, an opportunity where if these thoughts do actually convert into actions, then I think the next decade for our country is definitely, worth looking forward to. So yeah, with that, I'll stop here, and we can move on with the session. Thank you once again.
Thank you, Rajiv. That was a very candid expression of your views on the budget, and we would like to really thank you. Before I move on to the next speaker, Bhupender Singh, who is the sponsor for today's program under the Artham Law Chambers. He's a dynamic professional and an active member of the US India Importers Council. Bhupender has an immense work experience with PricewaterhouseCoopers and other leading law firms. He's founding partner of Artham Law Chambers, a boutique law firm which specializes in advisory, restructuring, and litigation. He's an expert on corporate and tax laws and has a large clientele of TMT, FMCG, pharma, chemicals, oil and gas sector. Over to Punit to start the day's proceedings.
Thank you.
Start the day's proceedings. Yeah.
Thank you, Dr. Rangaraj, and glad to be here. And we thank you everyone, the panelists as well as the lovely audience for having us here to discuss the budget 2022. Now, what we are going to do in next 10 minutes is primarily talk about some, customs and international trade changes, as well as the changes which have been announced for goods and services tax. If you can just bear with me for 1 second, I'll share my screen. We have a very brief presentation, which we can quickly run through for everyone. All right. Okay, so I think we'll start first with the GST proposals, because that's effectively, the talking point in last couple of days. So if you look at the GST proposals, government has kind of, looked at few industry representations in terms of the timelines, and also they have also looked at the situation of the vendor reconciliation. So the changes which have been brought into the input tax credit, the first and foremost good news for the industry is that till date, before the proposed amendment of Finance Bill 2022, the last date to avail any kind of credit for the previous financial year, April to March, was pegged at 30th September. So the companies just had another 6 months to kind of, resolve any kind of questions or queries with their vendors, and also to issue any kind of credit notes for the supplies of goods as well as services for the previous financial year. While many multinational companies have been making representation to the government that if the date could be extended by maybe 2 or 3 months on account of their global adjustments, which generally happen in the month of November, it appears that the government has looked at that request, and this date now stands extended from 30th September to 30th November. It's a win-win for everyone, because even the companies who do not have this 30th November kind of adjustment policy or requirement, even those companies will get benefited, and now there are additional 2 months to do the reconciliation. A major change which has been brought forward into the Finance Bill 22 is the omission of 3 primary sections, 42, 43, and 43A. These 3 sections effectively provided that all the suppliers will have to kind of file their returns, and once the return gets filed, that has to be pulled into the recipient's end. Until the time both sides of the end met in terms of the data points, that credit could be questioned by the authorities. What government has intended to do via this finance bill is that this entire two-way communication for the credit eligibility has been withdrawn. But at the same time, the government has also introduced another provision where the credit of any recipient of goods or services will get auto-populated based on the return, outward return, which is filed by its supplier. So what we look at GSTR 2B, going forward, GSTR 2B is going to be the return to take the credit by any company who is involved in the supply of goods or services. Now, the consequence of these 2 points, which is two-way communication being withdrawn and auto-population of inward supplies, the consequence here is that the credit will going forward be availed by the taxpayers on the self-assessment basis. Now here I'll just give a reference to earlier section 42-43. Earlier it said that the taxpayer or a dealer would be entitled to take the credit on a provisional basis till the returns get reconciled. Now this provisional basis credit availment has been done away with the omission of these 2 sections, and a dealer can immediately take the credit whatever is appearing in GSTR 2B.
Yeah.
A quick kind of touch upon points in terms of other changes on the input tax credit side. First and foremost is
Reversal.
Going back to GSTR 2B, what we discussed in the previous slide. In case some credit is not appearing in GSTR 2B, or at a later stage government gets to know that a particular vendor has not complied with filing of return provisions in subsequent months, then the government, as per the revised or amended proposals, government can ask the taxpayer to reverse the credit which would have been taken for the past period for that particular vendor. Now what it means is that a receiver of goods or services will have to reverse the credit, and that credit reversal has to happen along with interest. Now, this whole provision, at one side, it seems that it is putting an onerous burden on any taxpayer to reverse the credit with interest. But now section 41, the proposed amended section 41, it gives absolutely clear mandate that as and when this vendor would have filed the return, the recipient can take the credit or re-avail the credit immediately.
Okay.
Prior to this amendment, re-availment of credit was more in gray area, where many companies were taking a position. But with this amendment, it's absolutely clear now. An exceptionally welcome move by the government on the second point, which is the levy of interest in case where input tax credit is wrongly availed. Most of us might be aware during 2020 in one of the GST Council meetings, it was decided that any interest liability under the GST laws will trigger only if the credit is incorrectly availed and utilized. So the interest liability was not to trigger only on availment. So unless that same credit is also utilized, the interest should not have been levied. All of us, including industry, was expecting this change to come in the last budget, which was 21, because the GST Council had already conveyed their intention in 2020. But finally, this amendment has been proposed now. And the good news is that it's retrospective from 1st of July, 2017. Now, with this retrospective amendment, I think one big question which most of us will have to kind of, apply our minds to is that because it is retrospective from July 17, what happens to the interest which many companies would have ended up paying in last 4 or 5 years? Because the provision is going to be implemented now, while the cash outflow in terms of the interest has already happened in last 4 to 5 years. Okay. So this one point might need some sort of clarification either from the government, or there's a possibility that taxpayers may end up litigating on this point. Moving on from the GST return, moving on from the GST credit, now getting into the GST return piece. There have been some amendments in section 37 and section 39, which primarily deals with the filing of the returns. Now, the first amendment I'll talk about is amendment in section 37. I go back to the input tax credit slide, the very first slide, where we briefly said that a vendor's return, which is outward supply return, will get auto-populated in GSTR 2B for the recipient. Now, why this amended section 37? What the government has intended is that there will be certain conditions for submitting outward supply details. So all those details have to be filed as part of the return, outward return, and all those data points and the conditions will have to reflect in the GSTR 2B, which is the inward return of the recipient. Now, one of the conditions the government has proposed to notify is that in case a vendor's return is not filed, then at the back end, which is the GST network, that particular vendor's GST registration can be blocked. What it effectively means that if hypothetically my return is not filed and my registration gets cancelled, in the subsequent month, my recipient or my customer will not be able to take the credit. While from a government perspective or from a policy perspective, it's a very good move, but at the same time, we'll also have to see that it will have a major or massive impact on the MSME sector. Because MSME sector, for various reasons, there could be a delay of 1 or 2 months from the due date of filing of returns.
Yeah.
On similar lines as being provided in section 37, we have amendments in section 39 as well, which effectively says that we have today 2 returns, GSTR 1, which is for just reporting your outward supply. Whatever you have reported in GSTR 1, you have to pay taxes through GSTR 3B. In the past, we have seen many instances and some discussions with the government officials. There were many companies or taxpayers who were filing their GSTR 3B first, which is payment of taxes. And after 3B, they would file GSTR 1. So it was absolutely a reverse situation, what was not intended from day one in the GST laws. Why this amendment in section 39? The government has effectively clarified this position that no one will be allowed to file GSTR 3B, which is payment of taxes, unless and until GSTR 1 on outward supply has been filed. Just like interest on credit, this amendment also dates back to 1st July 2017, and hence it is retrospective in nature. I know we are kind of short on time, and there are quite a few questions which have already come in the corporate tax side. So I'll just take a couple of more minutes to run through these slides. Dr. Rangaraj, I hope that's fine.
Yeah, that's excellent.
Great, thank you so much.
Punit, now we will do the proceedings after completion. Gentlemen, it was indeed a very good analysis. It was a fantastic analysis and a good summary on the union budget, its implications, how they will implement it, and so on. In my capacity as the founder chairman of the US India Importers Council, may I now request our Bombay chapter president, a dynamic individual, Mr. Srinivasan, to do the vote of thanks and give his comments as the Bombay chapter president. Nalur, over to you. Yeah, please.
Yeah, I think before I give the vote of thanks, Bhupender has to continue his proceedings. A small chat between all the participants will be very useful.
Sure.
Bhupender?
Thank you so much, Mr. Nalla. Right, so we have got a few questions from the audiences. The first question is Mr. Srinivasan for you. In your discussions, you spoke about the push to the fiscal deficit, wherein you mentioned that the government might have looked at fiscal deficit slightly differently to give more impetus to the economic growth. So my question, or the question from the audience, is that do you think to kind of push that fiscal deficit, there could have been a lowering of the tax rates, income tax rates? Sir, you are on mute.
You're on mute.
Well, actually, it works the other way around because, in the near term, I mean, in the longer term, any reduction in tax levels across the board and making it easier to comply leads to better compliance and then higher collections in the long term. But in the near term, a reduction in taxes would mean lesser revenue, which would mean a widening of the fiscal deficit. So that was the reason that I really had no expectations that the minister would be giving away too much by way of tax breaks. Corporate taxes anyway have been already pared to the bone. I think we have a very, very competitive corporate direct tax rate. And for new firms which are starting operations, the rate is down to 15%, and that's very, very competitive. I don't think there is any room there to reduce taxes on the corporates. On the individual level, yes, I mean, there has been the perennial complaint of the taxpayer, which is largely the salaried class, that they get ignored budget after budget. But unfortunately, that's a reality. That the government, I don't think, is in a position to really forego too much revenue from the taxpayer, particularly with the higher fiscal deficit staring it in the face.
Great. Thank you so much. Mr. Punit, if I may,
yeah, sure. I just wanted to add to that, Mr. Srinivasan. I think you are absolutely right. Corporate tax rates are bare bone, 15%, 25%, whatever, whichever situation you are in. But for individuals, there is definitely scope for reduction. I think that was a very good question, because on a long-term basis, definitely it could lead to wider compliance, more collection of taxes, and hopefully reduction of fiscal deficit. So definitely there is a scope. We were all hoping that this year the tax rates would be reduced, make it more competitive, but hopefully next year.
Sure. And I think there's hope in every situation, and that's what we look forward maybe for the next budget, that there will be some sort of tax rate changes for the individuals at least.
Yep.
Great. Thank you, Mr. Punit. I'll just quickly move on to the next question, which has come to us. Again, Srinivasan, it's for you, and I'll thereafter move to Mr. Rajiv for his inputs. The question is in relation to the MSMEs. So the question is that, do you think that in the current situation where, the government is also looking forward to give boost to the startups and the MSME sector, could there have been something more in this budget for MSME sector?
Certainly, I think, one is that, the government will, or the finance minister will turn around and say that I increase the emergency credit line guarantee scheme limit by 50,000 crores. In fact, the additional increase has been targeted at the hospitality and services sector, which has been hit the hardest by the lockdowns. But, for MSMEs, it's not just about easier credit or just access to credit. I think they are grappling with multiple situations, and credit and cash. Credit is one issue, but cash flows are equally important. And one of the biggest problems that MSMEs is struggling with today is sort of choked up cash flows. Mr. Bhupender Singh touched upon the many sort of beneficial amendments in the financial bill as regards GST, but I would like to ask him how much that will translate into rapid refunds, which is the one thing that any MSME business operator is concerned about. There's a huge amount of money which is just simply stuck in the pipeline, and that is mostly out of the MSME pockets, because the big companies know how to take care of that issue. So that's another issue. Then there are multiple other things, all of which are either in the hands of the center or capable of being addressed in the by the budget. But particularly because MSMEs operate at in state level environments, and this state ease of doing business environment which is offered in a particular state often has much more impact on an MSME's fortunes and whatever provisions can be made at the central level. So there are many other things which can be done. MSMEs have a long list of demands. I think if you did two things, for instance, if you brought petrol and diesel into the GST framework, and if you brought electricity into the GST framework, you sorted out 50% of their problems. But these are just to name a couple of initiatives which could be taken. So yes, there is this thing, but on the credit fund also, the ECLG, this thing, that limit is, it must be noted that most of it is already used up, and there are a lot of ifs and buts attached to it. You can only avail of it if you haven't availed of any other moratorium or benefit by March. There are nitty-gritties in the details, so which means that there is not much extra available for somebody who's currently in requirement of credit. So that issue could have also been at least addressed with maybe a higher allocation for that. So yes, a lot more could be done for MSMEs.
Thank you so much. And Rajiv, if I can have your 2 cents on this particular piece.
Yeah, I think from a credit standpoint, I agree with what Mr. Srinivasan said, right? But then again, it's you can't clap with one hand. There is a huge fatality rate even in the SME and the MSME and the startup side of things, right? So that's something which needs to be factored in at a much broader level. What I feel is that there are certain aspects which have been looked into. For example, and I'm just correlating over here, something like a data center coming into infra, right? A data center is something which the Western world or the developed world has established almost 15-20 years back, wherein you do not have heavy infrastructure requirements in your own premises within your own control, where you just outsource it and get it done with, right? Things like that. The other good thing that I saw in this time's budget was the ability to wind up. Again, the winding up process is something which is, which helps you. Like they say, if something has gone bad, it's better to destroy and make it rise again like a phoenix, rather than dragging it through the gutter for 2, 3, 4 years, right? And creating more pain. So I think there are positives for startups. Again, the whole tax bit which has come up on the startup funds and the ESOPs part, which I think is also a big positive, where you will be able to have a much wider distribution of wealth. And lastly, I think, yeah, the corporate rates and all is standard. They get their holidays. You have the Gift City initiative, which has come up in a big way, right? Where the government is encouraging Gift City as a hub, right? Where foreign currency flows, getting, a tax holiday for 10 years and all of it is something which needs to be leveraged, right? It needs to be leveraged effectively before we kind of say that, oh, this is not working and that is not working, right? So I kind of would like to balance the view. But yeah, I think there could be, like he said, a few more things that could be done to give it more impetus.
Great. I think it's a fantastic point of view in terms of balancing both the sides, because as you rightly said, you can't play with a single hand. Yeah. Just one quick last question before I request Mr. Nello to kind of indulge us. And the question is, Mr. Punit, for you on the digital asset taxation. So the question is quite kind of open-ended. It goes that, do you think that with this proposed taxes of 30%, while the legality of the digital assets per se has not yet been clarified or legislated by the government, do you think 30% could be a bad news for the investors who are into digital assets?
It's not so bad news. It's good news and bad news. Good news, again, because it has been recognized now as a legitimate source of income, and anybody who earns income better pay taxes. That's what Revenue Secretary also mentioned. So it would not be appropriate to assume that any income you earn on trading of any digital asset or whatever would go tax-free. There is no such provision. So the tax was inevitable. It was only a matter of how it will be taxed and what rate. And I think 30% is a reasonable rate. It is not considered to be like capital gains, where you would get a concessional tax treatment of 20%. It is, in a way, it is considered to be a normal income, where you are paying a full rate of tax, which is the highest rate of tax, which is 30%. And for individuals, again, it is 37% surcharge. So it can go as high as 43%. But that's the nature of the beast. I would say that's it's a step in the right direction. And yeah, I think it's something which is now legitimized. So you'll be able to declare this income, pay taxes, and at least use up that money.
Well, great. I think that nails it down completely. There are a few more questions, but in the interest of time, I think we'll respond to the participants later. Mr. Nello, over to you. Sir, you are on mute. Mr. Nello, we can't hear you.
And you
Yeah, thank you, gentlemen. That was really wonderful and a fantastic take on the budget, on some of the major aspects of the budget analysis. Thank you very much. I thank Mr. Rajiv of Dhruva Advisors. I'm sorry, Mr. Punit Shah of Dhruva Advisors, Mr. Rajiv Hingoo of Jefferies, India, Mr. Srinivasan, Senior Journalist and Economist, and Dr. Rangaraj, our founder chairman, and ex-US consulate, and author of wonderful treatise on Indo-US relationships. And of course, Bhupender has also been instrumental in majorly supporting this webinar. Yes. And I would like to specially thank my associates, Robin Rosario and Suresh Krishna, for supporting this event right from the start. And thank you all very much. And thank you, participants. Till next time, till next occasion, this is Nallo Srinivasan of USIIC signing off. Cheers. Bye.
Bye. Thank you so much.
Thank you.
Very good. Excellent